So I want to talk about the wheel strategy. The wheel strategy is one of my favorite strategies that I've been utilizing in my portfolio for steady, consistent, profitable results with high quality companies. You guys know that I like to have basically blue chip stocks, and a lot of my stocks are actually tech stocks. And I also trade lower price stocks like JetBlue that have a lower share cost, because then it's easier for, smaller portfolios to get in. But for me personally, the wheel strategy, I would just honestly do them on technology companies. I'd also pick big brands. So for me, like if we scroll down in my portfolio, some big brands that I would personally be using the wheel strategy on would be Starbucks. Or looking down here, obviously Tesla would be great for the wheel strategy. Hims is pretty decent because it's under $10 per share. I would also look at potentially Sweetgreens. This was my favorite salad spot at University of Pennsylvania. And then looking at Alibaba. This is a good company for selling put options. Now the wheel strategy is essentially just selling put options to get into a company. And then once you do get put at a price that you determine, right? You want to determine the price. So, for example, let's use Alibaba. I would place this trade if the market was open, but let's just see. Okay, so the current stock is at $75. If I go to the 3-month chart, you can see here that the stock is moving down. Now, technically speaking, you want a stock that is on the lower end. In fact, one of the biggest factors that I look for is if a stock is near a 52-week low. So for example, like Alibaba is currently at $75. And if I look at the 52-week low, you will see that it was at $70. So that means that in the past 52 weeks, this stock was not lower than $70.08. So it's gonna be a very wise move if you just go for a $70 put option. Now, to begin the wheel strategy, what you wanna do is you wanna sell a put option. So I'm going to go to sell put. Now for me, expiration day is important, but it's not as important as you may think. A lot of folks are asking me, is it better to go weekly or monthly? Well, the fact of the matter is it is actually easier to manage a position that's expiring further in terms of dates. However, you want to be careful because I can go out, really far into the future, like let's say September, but then this becomes really boring, there's nothing to do, and this is also potentially suboptimal. What is optimal is to go for an expiration date that is between 1 to 6 weeks. Now, why do I choose 1 to 6 weeks? Well, the reason is because of theta. Let me show you an example. So let's go to January 19. All right, so if I were to run the wheel strategy here, again, I would sell a put option at the $70 strike because Alibaba 52-week low is around $70. In fact, it's a little bit higher by 8 cents. So if I were to sell a $70 put, I would collect 83 cents. This means that I would collect over 1%, and this is going to expire in 26 days. Now, again, taking a look at theta, the theta is 0.0356. That means every single day, this option is decaying or losing about $3.56. So that means that you are making $3.56 every single day on autopilot without having to do anything. And that's amazing because for 26 days, you really have no management. A lot of folks ask me if they should close a position which is 50% up. So say that I sell a put option at $70 and I sell it for 83. And now let's say that in 2 weeks, it's worth $40. So I have made $43. Well, should I close this position or should I hold it until expiration and make more money? For me, it really depends what the return is for the rest of the time remaining until expiration. So for example, let's say that you made half of this premium and that all happened in 1 day. Well, in 1 day, you made 50% of the premium. So yes, in that case, I would close this position and I would potentially open up a new position, say the 71 or the 72, so I can make some more money. However, let's say that you made half and there's only 3 days until expiration. That means in 3 days, you're gonna make $40 more. In that case, I would wait until expiration. So it's just a careful balance where you have to determine for yourself, is the remaining premium that I'm going to make for the remaining amount of time worth it for me, or is it not worth it? There is no optimal answer. It's just, is it worth it or is it not worth it? How much am I getting paid here and how much do I have to wait? If I were to do the wheel strategy, I would sell the $70 strike price. I would collect $83. Now, as soon as I did this, I would essentially just wait until expiration. For me, I have noticed that the biggest raw return, what I mean is the raw return, the amount I make is the highest when I wait until expiration. However, there is a difference between returns and risk. Okay, that is the fundamental finance formula. There's return and risk. And so many people are just looking at how much am I making? It's also really important to understand risk management. How much are you risking? how much are you putting on the line? And that's really important to understand. And for me, I like to keep it really minimal. So as I share this example, actually I just want to show you my portfolio year to date as we wrap up the year. Happy holidays. And let me know in the comment section, what are you doing for the holidays? And if you're watching this in the future, let me know what stocks are you running the wheel strategy on. And again, I am taking my own calls personally. So the first link in the description, you can schedule a call to learn about my Discord community where I do trade live. I can also coach you one-on-one, and I'll show you everything that I'm buying and selling to make you a profitable option trader. I am personally taking those calls, so there's not that many spots, as I will guarantee that I am taking that call personally and it's not someone on my team. Now, check out my return. Year to date, it's 26.77%, and I made $380,000 in this portfolio. Now, for me, this is a pretty typical year. I have made a lot more in prior years, but I have also taken more risk. As I have scaled my portfolio, it makes a lot more sense for me to have consistent, profitable, and steady results. I really don't want a lot of volatility, and that's why you see my portfolio is actually less volatile than an index fund, because I'm running the wheel strategy. That means when the stock market goes down, the wheel actually helps me outperform the market, because when I'm selling put options, I'm collecting premium, and if the market falls 2%, I actually don't fall any percent. I'm just flat because my options are typically 2 or 3% out of the money. Again, depends on which stock. For me, I've been making pretty big bets on Apple. So if I go to total return right here, currently down, but I've been trading Apple for a very long time, and it's one of my biggest positions. In fact, I've made over $73,000 in the past 3 months trading Apple. I'm also trading some smaller cap stocks like AMC. AMC is pretty risky. However, I think it's a good and interesting small account strategy. I'm also using Amazon. Kraft Heinz is one of those stocks that I really like using the double dividend strategy on. Now you can see how you can use a double dividend strategy when a stock basically pays a dividend and then you do a covered call, collecting 2 dividends. So taking a look at Kraft Heinz, you'll notice that the stock is currently at 36, and I have already ran the wheel strategy on Kraft Heinz, and when I sold some put options, I did get assigned. Now that I own the stock, I can sell covered calls against my position, and you can see here that I made $51. This is not a lot. However, Kraft Heinz is a pretty safe stock. It has a dividend, and I have made money on the covered call and the sell put, which again is the wheel strategy. The wheel strategy is when you sell puts to get in and covered calls to get out. Here's another example of the wheel strategy that I really want you to pay attention to. The wheel strategy offers a level of security that few other strategies can match. When it comes to investing, I pay very close attention to managing the wheel strategy properly by opening and closing the position correctly. Because if you don't do that, then you're not going to get the big returns with low volatility, which is the whole cornerstone of the wheel strategy. We'll explore how this safety net ensures that your capital remains protected while growing with examples very shortly. Whether you're starting out with a small account, a medium account, or you have a large account that you're managing, the wheel strategy adapts seamlessly to your situation. In the wheel strategy, you start by selling or writing a cash secured put option on a stock you wouldn't mind owning at a certain price, which is the strike price. The perfect entry point begins with selecting an appropriate strike price for the put option. Now check this out. Say a stock is at $110 per share. For me, I typically like to choose a low delta. A low delta could be 20 or 23 or 24. If the stock's at 110 and you sell a $100 put, that means that you can buy the stock for 100 instead of 110. Crazy, right? Ideally, you want to choose a strike price that is below the current market price of the stock, but at a level where you are comfortably owning the stock if the option is exercised. That means if it goes to $100 per share or lower, you're ready to buy it. But look, that's not a bad thing if you're doing this on really high quality companies, say Apple, Amazon, Google, Microsoft, and potentially Tesla, because these companies have alpha. They've been outperforming the market. They have really good growth rates. And that's the type of stocks that I want to use for the wheel strategy. If you're doing this on stocks that you already like, this is the most overpowered cheat code strategy that I have on my channel. Now, please, I can't tell you how often my students change their mind. They end up panicking and they sell a stock only for it to go back up instantly. I hate that feeling, and I'm sure you've experienced that feeling for yourselves. So don't get emotional and have a game plan when you get into this option position
position to begin with. And what I really like about the wheel strategy is when you get in, you're picking a strike price ahead of time so you can decide for yourself, do I want to own this stock at say $100 per share? You also want to look at fundamental and technical analysis. Now for me, I obviously really like good companies that have a good balance sheet and a good cash flow, and timing is crucial when implementing the wheel strategy. You want to sell the put option when you believe the stock is trading at a fair or even slightly undervalued price. Now again, if you pick a really high delta, then your chances of getting assigned is just way too high. But then again, look at it from the other side of the mirror. If you end up selling at a delta of say 8 or 9, yeah, you have so much safety. Of course, you're gonna be winning like over 90% of the time. But here's the thing, I still managed to win 90% of the time by picking a little bit higher delta. And the way I do that is by technical analysis. And also, if you end up selling a very low delta, to be honest with you, there's just not that much premium there. You really wanna dial in that sweet spot, which again for me is between 20 to 30. Now, you can run the wheel strategy on SPX, QQQ, SPY, and other ETFs to make life very simple and easy. I have a monthly list of stocks in my Discord. Again, the wheel strategy is a bullish strategy. And a bullish strategy means that you want the market to be going up slightly, but I'll tell you the truth, with the wheel strategy, if the stock market goes up, you make money. If the stock market goes sideways, you make money. And even if the stock market falls slightly, you're still going to be making money. This is also great for avoiding losses. And if you pick the wrong stocks, you can still do okay because the wheel strategy has a lot of built-in margin. It's also crucial to protect your money and grow it rather than chasing unrealistic results with high levels of risk. And that's something really important that Warren Buffett talks about. That's something important that I learned back in my financial education. I have 4 different degrees, accounting, finance, analytics, and economics. And in my studies, I've really learned that having a margin of safety is so important because you can be wrong about a stock, and if it falls down 10%, but you picked an option that's 10% out of the money, that means that you don't get hurt at all. Whereas all the stock investors, they're getting hurt 10%. Can you imagine? You're literally getting paid even if the stock goes down. Now, if you work a full-time job or you have a busy schedule, the wheel strategy is great because it's truly passive income. I'm all about living a lifestyle of freedom and not having a boss, not having to work a 9-to-5 job, and also not being on the computer all day long. The wheel strategy is so passive. Once you open up this strategy, there's very little management. Now, once I open up a position, I do leave it alone, and a few things can happen. Now, number one, the first scenario is the put option expires out of the money, or OTM. In this scenario, the stock price remains above the strike price of the put option until the option's expiration date. The put option expires worthless, meaning you get to keep the premium you received when you sold the put. And yes, whenever you sell a put option, that cash is available in your account immediately. You can then proceed to sell another put option for the next expiration cycle to continue generating income. Now, scenario 2, the put option expires in the money, or ITM, and you are assigned the stock. In this case, the stock price has dropped below the put option strike price, and you're obligated to buy the stock at the strike price. You will need to use the cash you set aside, which is called collateral, to purchase the stock at the agreed upon strike price. This is why if you have a small portfolio, you want to trade stocks that are below $40 per share. Now, scenario 3, holding the stock after being assigned. After being assigned the stock, you become the owner of the shares. Those are going to be 100 shares for each contract that you sell. At this point, you can proceed to the next phase of the wheel strategy, which is selling covered calls against the stock. If the stock is called away, for example, the call option is exercised by the buyer, you will sell the stock at the strike price that you choose. This is where things get really interesting. So say you sell a $100 put and you get assigned. Now, that Monday, the stock is actually at $101. Well, what you can do is you've already made $1. Now you can sell some covered calls on this position and make more money. If the call option expires worthless or out of the money, OTM, you retain ownership of the stock and you can continue selling covered calls over and over again. And if you don't even get exercise on the put that you sold, then you can just keep doing cash secured puts over and over and generating income. Whenever I sell puts, I actually do it on margin. But first, you need to get educated and consistent before you use margin, because that could be really risky if you don't know what you're doing. So let's talk about scenario number 4. The strike price continues to decline after assignment. Now, this is pretty dangerous, and this can happen, especially in a bear market. You may incur a paper loss on the position. However, you can continue to sell covered calls, which can help mitigate losses and potentially earn you additional income. Now, if the stock does rebound, you can consider selling the stock or just repeating the wheel strategy by selling cash secured puts at a lower strike price. Now, the fifth and last scenario, the stock price rebounds after assignment. Now, this is just awesome, okay? Whenever you get assigned and the stock ends up going up and rebounding, that's the best situation that you can be in. In fact, that's the situation where you can laugh all the way to the bank. Ha 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 ha. All right, so as you can tell, you want to closely study these scenarios. You truly don't need to run any other strategy, as the wheel is a dynamic strategy that utilizes selling puts to get into the stock and covered calls to get out. Wheeling stocks will provide you steady income. Cheap stocks are also great because you can deploy a small amount of capital and diversify easily. The win rate on the wheel strategy is almost 100%. If you pick the right companies, at the very worst, you have to give the stock time to recover and you will always be up with this strategy. I'm successfully wheeling Palantir, as you can see, up $269 on the stock and $116 on the options. Now look, notice how my average cost is $15 per share. That's because I got assigned when I sold a 15 put option, and now I am wheeling $16 call options. Simple and profitable. Here on Amazon, despite my option being down $369, my covered call position is still up over $1,800. I have clear rules against exiting a losing trade. I want to make profits on all of my sell puts, covered calls that compose the wheel strategy. Now, of course, that's easier said than done, but if you do this properly, you will have a lot more gains than losses, and you will minimize your losses to the point where they won't even hurt your gains that much. Your risk management really has to be at a decent level, since a big loss can wipe out a lot of your gains. When selling a put option, pick a strike price that's 5% below the current value of the stock. If it's a volatile stock like Tesla, you'd want to go more out of the money, meaning 10% or even higher if it's a very volatile stock, which, by the way, I don't recommend trading the most volatile stocks. I like medium amounts of volatility. Now, you need to plan this ahead of time because unlike other strategies, the wheel, once open, isn't the best to adjust. You really do want to hold it and do very minimal management. However, you can definitely adjust it if you have a change of mind on where you want to enter the stock. For example, say you sell a 95 strike put option planning to enter the stock at that level. Let's say you have a sentiment change about the 95 strike that you chose. What you can do is easily move the 95 strike down to 90. This is where monitoring the position is important. There is a difference between monitoring it and having freedom and babysitting and not having freedom. I cover in detail in the description. This includes tracking the price movement of the underlying stock and assessing the time decay or the theta of the option. If the stock price remains above the strike price of the put option, you still have a bullish outlook on the stock. You may not need to take any action at all. In this scenario, the put option will likely expire worthless and you will keep the premium you received when you sold the put option. You can roll the put option to a later expiration date while keeping the same strike price. This allows you to extend the duration of your position and potentially collect additional premium. If your view really shifts, you can move down by a few strikes and get paid for it. It's an unbelievably profitable strategy. And during the 2022 correction, I had a large position on SPY where I lost $31,000 on paper. In 30 days, I was able to recoup my paper losses by rolling my put lower. That was a massive savings I had, just like with my recent Apple trade where I am running the wheel strategy. You can literally see how I bought 3,000 shares for $176.85 a day after selling those shares for $182.91, all while running the wheel strategy in between, making thousands. You can see how I decided to actually take profit in the same day on the 170 sell put. And I do encourage you to do that. If you make a lot of money short term, why not take profit? I collected $3,850 and then I bought it back for $3,430. That was in 1 hour, making me $420 very quickly. If you want to follow which stocks I pick and watch me trade live this week, you can check out my free training before scheduling a call for my Discord in the first link below. The research I've done while at Goldman Sachs points to this strategy outperforming in tough conditions. That's exactly why I tell all of my retirees that this is the best strategy for retirement income. It's also the best strategy for growing a small portfolio consistently next to my higher risk Golden 3 strategy, which I only recommend to higher risk takers. That video is on my channel, as well as margin trading. If you have any questions, shoot them down in the comment section below and I will read every single comment. Make sure to like this video, subscribe, and watch again for the scenarios.